Hello, everybody. My name is Wes. I'm your financial advisor coming to you from the Florida Keys. Growth and value stocks are often presented as opposites, almost like you're supposed to choose one or the other. In reality, they're not competing philosophies. They're just different ways the market categorizes companies based on how they're priced and how investors expect them to grow. In this video, I want to explain what growth stocks are, what value stocks are, how they behave differently, and why this distinction actually matters. Let's jump right into it. So, what are growth stocks? Growth stocks are companies that investors expect to grow faster than the overall market. That growth might come from expanding revenue. It might come from increasing market share, new products, new services, or operating in fast growing industries. Because of those expectations, growth stocks are usually priced higher relative to their current earnings. Investors are paying for future potential, not just present results. On the other hand, what are value stocks? Well, value stocks are companies that the market is pricing more conservatively. They often have stable businesses, generate consistent cash flow, and operate in mature industries. Value stocks typically trade at lower prices relative to earning, sales, or book value. That lower price can reflect slower growth expectations or simply that the company is out of favor at the moment. Value investing is about paying less today for what already exists. Now, the key difference between growth and value stocks is expectations. Growth stocks are driven by what investors will hope will happen. Value stocks are driven more by what the company is already doing. Neither approach is inherently better. They just respond differently to changes in interest rates, economic conditions, or general investor sentiment. So, how do growth and value stocks behave? Well, growth stocks tend to perform well when optimism is high, benefit from falling interest rates, and usually experience larger price swings, aka volatility. Value stocks, well, they tend to hold up better during uncertainty, and they benefit from higher interest rate environments. They do offer more stability, but that means it's less exciting, less volatility, less major growth. And as always, neither style outperforms all the time. It rotates and it changes as the economy moves forward. Now, there are long stretches where growth leads and long stretches where value does. Oftentimes, this has less to do with company quality and more to do with economic cycles, interest rate environments, and what investors are willing to pay for future growth. This rotation is normal. It's how the market moves. And trying to predict which style will outperform next is extremely difficult, even for professionals in the field. Now, there are several misconceptions regarding growth and value stocks. One common misconception is that growth stocks are always riskier. Another is that value stocks are safer. In reality, growth stocks carry expectation risk. Value stocks carry business or relevance risk. Risk isn't eliminated by choosing a style, it's simply expressed in a different format. So, how does this topic actually fit into a portfolio? Well, most long term portfolios include both growth and value exposure. Why? Because diversification isn't just about owning many different investments, it's about owning different types of risk. And growth and value stocks tend to perform well at different times. Holding both helps smooth the results over full market cycles. Now, there is a behavioral aspect to this. Investors often gravitate toward whichever style has done well recently. If growth has outperformed, well, then it feels obvious. When value bleeds, it suddenly feels sensible or like it makes sense again. This chasing behavior usually hurts long-term results and is harmful to your financial future. Understanding growth versus value helps investors set expectations and stay disciplined. Now, to wrap all this up, growth and value stocks are not a debate to be won. They're simply tools. Each reflects a different way companies grow, earn money, or valued by the market. The goal isn't to pick the right one at the right time. The goal is to understand how each behaves and how they work together inside a long-term plan or maybe your own portfolio. Because in investing, clarity matters more than certainty. I thank you all so much for watching. I really appreciate you tuning in. As always, I'm trying to improve my craft. So if you believe I could improve on anything, you have any suggestions, please let me know in the comments below. Have a wonderful day.